Coming up in today's show, stocks finish lower again, an update on the Middle East war, why some say now is a buying opportunity in stocks, could we see an upswing back in inflation, and price action analysis on weekly charts. Welcome back to the Click Capital Daily Market Show, everybody. Hope you're doing well going into the weekend, and if you're new to this channel, welcome. My name's Jared. I make these videos every day after market close to keep you updated on all the latest financial news, data and charts, along with some analysis. So if you haven't already, hit that subscribe button, and these videos will show up on your YouTube home screen every time you log in. And so we just finished another interesting week on Wall Street, again on a soft note, with some more vicious sell-offs in individual names that we've been seeing this week. Like Oracle down 6% today, American Express down 5.3%, a lot of regional banks came off really hard today, and Tesla fell another 3.6%. There were a few spots of green in some of the defensive sectors like healthcare and consumer staples. And stick with me today because I'm going to go through all the charts on the weekly time frame and give you a bird's eye perspective of everything that's going on out there in the market and what all the trends are. So first, just a bit of an update on the Israel-Hamas conflict, as that's impacting markets a little bit here, namely in oil and gold, and could be adding to the nervousness in stocks. And there's still intense fighting going on in the ground. And so far, Israel troops haven't gone into Gaza, but they could be about too close. But America and the Europeans are trying to get them to hold off a bit whilst they can get some humanitarian aid into the Gaza Strip and trying to kind of cool things down from both sides. And so world leaders are trying to stall the Israeli forces from going into the Gaza Strip to give Hamas a chance to release those hostages, of which they've already released 2 American hostages. But apparently there's up to 200 inside the Gaza Strip from countries all around the world. And so very much a fluid situation that could get a lot worse. Like the United Nations says, the Middle East is on the brink, with the most difficult moment between the Israeli and Palestinian people in the last 75 years. So hopefully it stays contained for the sake of innocent civilians. However, it is possible that Iran and Russia want chaos and possibly may want America to enter the war in the Middle East, which would then give an opportunity for China to go into Taiwan, with America's focus being split and spread thin in Ukraine and Israel. So it's still possible that Iran give the Hezbollah militant group, of which there's some 150,000 soldiers with tens of thousands of rockets, to full-scale attack Israel. Then America would probably have to get involved in that, and we may see more militant groups come out of Syria and other neighboring countries, as many of them openly call for the elimination of Israel. And after an initial weak reaction, that's what's seen oil rise a bit this week, as the market is on edge and nervous about what could happen over there, as the Middle East is the swing factor in global oil supply, and we've already got rockets being fired at US military bases and Navy ships, and so far things are not moving in the right direction. But just looking at the daily chart of crude oil futures, actually pretty flat today, finishing just above $88 a barrel, after briefly almost getting up to $90 a barrel. Still put in a higher high, higher low today, and pretty strong bid in gold as well. We got a bit above $2,000 an ounce today, just touching this resistance zone. We are now a bit above the buy-sell band and DSI, so we could have a bit of a pullback here, but there's been a lot of strong volume coming in over the last week, and this has really got to do with how nervous investors are with what's going on in the Middle East, because the usual flight to safety asset like long-dated treasuries have been getting absolutely bushwhacked the last couple of months, like we can see in the ETF TLT, which actually managed to stabilize a little bit today on the back of long-dated bonds like the 10-year yield, just pulling back a bit from that big 5% level we reached yesterday afternoon, finishing the day at 4.91%. And we can see that flight to safety in gold versus treasuries in the spread chart of gold versus TLT, which has had a very sharp run out this last week and a half on the back of that escalating conflict. And that's what's helped push the S&P 500 down through that big trend line we've been watching since October last year when the market bottomed. And stick with me because I'm going to come back and go through all the charts on the weekly time frame today to give you a bird's eye perspective on where all markets are right now. But it doesn't look good with markets finishing right on the lows here, and this could definitely spill over into next week. And this is usually when accidents happen in the markets, when things are already sliding and slippery like they are now. And we can see that with the climbing VIX almost reaching 22 today. However, looking on the other side of the coin, on a brighter note, which I always try and do on this channel and stay somewhat neutral, showing both bullish and bearish arguments for all markets. And we've got JP Morgan saying that demand destruction will outweigh a wider Middle East conflict in oil markets, because they say even if the Israel-Hamas conflict expands, falling oil consumption will keep prices in check. Higher prices paired with declining currencies and surging borrowing costs have already cut into oil demand. And looking back in history, analysts have noted that Israel's previous military conflicts have have rarely caused a lasting price turmoil in the oil markets. They go on to say oil demand in Taiwan, Thailand, Japan, South Korea has fallen, while total crude imports into Pakistan, Bangladesh, and Sri Lanka are also down. And for now, JP Morgan doesn't see the Israel-Hamas war spreading to a more regional conflict, saying that Israel, Iran, US, Saudi Arabia, and the United Arab Emirates have strong incentives to keep the conflict contained. So let's hope they're right, as a higher oil price hurts us all, and hopefully things don't go the way like they did after the Yom Kippur War in 1973, when a bunch of Arab countries attacked Israel in a similar setup to we have now, and the price of oil absolutely skyrocketed, not only that year, but much into the rest of the 70s, adjusted from inflation, going from about $25 a barrel up to $140, causing a huge amount of inflation for most of the 70s and a very weak stock market. The best place to hide out during that time was gold. And some are already noticing that inflation is following an eerily similar path as the one taken from the late 60s to the early 80s, encompassing that period of the oil embargo from the Middle East. And we can see that in this chart here of the Consumer Price Index CPI year-over-year change in the blue line from 1966 to 1982. We had three distinct waves, with each of them getting bigger. The first wave, 1970, up a bit over 3%. Then it came right back down to mid-72. Then we got the outbreak of the conflict in the Middle East, went right up to 9%, came back down going into 77, and then shot right back up to a new high above 11% in 1980. And in that period, stocks and bonds were weak, as obviously central banks were raising rates to try and get on top of that inflation. And here we are today in the dotted yellow line, starting 2013 to where we are now, getting into late 2023. But obviously, inflation's come down a lot this last year and a bit, with the price of crude falling as well. But we've seen the last couple of months crude move back up. So it's still very much possible, as much as many say that the Fed is done, inflation's on the path back to 2%, the stock market really hopes so. It is still possible that inflation follows this same path from the late 70s and we see a second resurgence. Because back in the 70s, there was just that spike in oil, and the world only came off the gold standard in 71 to free floating fiat currencies, whereas the last 15 years we've had central banks absolutely flood the system with $9 trillion in liquidity on top of rock bottom interest rates. So I would say there's even more ingredients there for a second wave higher in inflation. But at the end of the day, nobody knows for sure. Inflation could go back down to 2% in the best case scenario, but who knows, next year oil could be at 120 a barrel and inflation could be on the march back higher following it. Adding to the upside in inflation and rates is the US government, which can't stop spending significantly more than it makes, with it just finishing the fiscal year with a budget deficit of $1.7 trillion. That's up 23% from the prior year, and that huge deficit came as revenue fell by $457 billion from a year ago, and expenses decreased by just $137 billion. US federal debt is now up to $33.6 trillion, and that's grown by more than $10 trillion since the first quarter of 2020, when COVID first hit us. But Janet Yellen doesn't seem worried with how much the US can print, because like she recently said, the US can absolutely afford 2 wars. I wonder what she thinks about a third war with China. How much will that add to the federal debt that many young people today will have to keep working and paying off for years to come? So the bond market's well aware of all this, and they're kind of putting the squeeze on the government, pushing them into a corner. They know they can get a much higher rate with all this record issuance from the Treasury, and so the market's doing the Fed's job for it and putting the squeeze on the economy and the government's spending habits. And there's still some within the Fed who think they could do one more rate hike, like the Cleveland Fed President Loretta Mester. She still views inflation risks to the upside, pointing to higher oil prices since July that could seep into core prices and higher gas prices that could make consumers think inflation will be rising again. And we have seen CPI tick up over the last couple of months, a bit above expectations as well. However, I do think we'd need to see some more hot CPI prints to come in for the Fed to really think about adding more fuel to this fire. But for now, the market only thinks there's about a 30% chance they will do that again in January. It's pretty much a given they're going to pause when they meet in a little over a week on the 1st of November. However, regardless of the strong rise in yields, some think this could be a buying opportunity in the stock market, as a lot of investors turn extremely bearish. And Bank of America highlighted that its proprietary bull and bear indicator entered buy territory this week, with them saying the stock market has historically seen a median gain of 5% after this buy indicator flashed. And that's based on a contrarian signal going against a lot of investors who have become a lot more bearish, and we can see that in the options market, with the amount of put options being purchased increasing. Some others are also pointing out the stock market's volatility indicator is signaling a low in the S&P. It's quite often when the fixed spikes we're closer to the low than the top. And it's true, the VIX is spiking here, but the thing you got to remember is no one knows how far it will spike. Because a lot of the time it can spike up to 25, 27, but it can also spike above 40. And things get bad enough, it can also spike up to almost 100 like it did in October 2008, or above 80 like it did in COVID March 2020. However, since then, most spikes have been above that 27, 28 level, with a few getting above 35, and we're only here today at 2170. So it's not a huge spike in historical terms where we are right now. And just because the stock market as a whole doesn't look too good right now, doesn't mean there isn't individual bargains to be picked up for the long term. Even if we do see another year or two of big volatility, savvy long-term investors will use sell-offs as opportunities to start scaling into long-term positions. And we're seeing that with billionaire investor Steve Eisman, who say he's buying stocks rooted in the old economy, and he doesn't think there's a new housing crisis in sight. He calls his thesis Revenge of the Old School, noting he likes old economy stocks. And those of you who watch my channel know I've been sharing a similar sentiment for the last few weeks as well. He also said he's been buying bonds for the first time in his career, and he also likes equity names in the construction, utilities, and materials space. Me personally, I like some names like General Motors, Walgreens, 3M, AT&T, and Verizon, and a bit more of a newer one, a beaten down utility nonetheless, NextEra Energy. Some of the old economy stocks I like as a long-term investment at current levels. That's not to say they can't get a lot cheaper. However, these businesses will still be around for many years, and the cheaper they go, the more of an opportunity they could be. Okay, so it's the end of the week. Here's a look at what's coming up next week. Getting into the thick of Q3 earnings season, with it really gearing up Tuesday. Some of the big ones coming out: Microsoft, Alphabet, Coca-Cola, Visa, along with some PMI economic data. Going into Wednesday, we'll see earnings from Meta, Boeing, and a bunch of others, along with new home sales. On Thursday, we'll get to hear from Amazon, Intel, Ford, along with a bit of economic data, PCE, jobless claims. And then finishing out the week, we'll hear from ExxonMobil and some personal spending and consumer sentiment data to give us a bit more of a read on the consumer. And just looking at some economic data we've got, inflation out of Japan came in a little softer than expected, 3% year over year. Retail sales out of United Kingdom contracting a lot more than expected, off 1% year over year. Doing a bit better in Canada, coming in a lot higher than expected. Retail sales grew 1.6% year over year. Market's still on the edge. We can see that in the fear and greed index, sitting right at the top of the extreme fear zone. Like I showed you on the VIX chart, this is not a real sharp, deep sell-off yet. That could become that next week, as I'll show on the charts in a bit. But right now, things are getting elevated and getting a bit more dicey. And a lot of the time when the market dips, you'll see corporate insiders usually step up their purchases of their own stock and buy the dip, like we saw back in March. After the regional banking crisis, market sold off a bit. Corporate insiders increased their purchases, and for a day there, even outnumbered sales, 185 to 132. And most of the time are usually selling stock, so that's why it's normal to see a lot more sales and purchases. However, the market's been dipping the last week, and corporate insiders have shown no interest in buying this dip, and typically they're pretty good at timing the market, buying the dip, selling the rip, and still no much interest from them down here. Okay, so today I'm going to do something a little bit different. We're just going to stay on the weekly charts since it's the end of the week. And we do this to get a bird's eye view of all the markets and just kind of step back from the noise a little bit and see what the medium and long-term trends are. So here we are on the S&P 500, just breaking down through this trend line, finishing on the lows for the week, but still not a bad week overall, only down 2.3%. The Nasdaq a bit more, down 2.92%, getting down to the lows. And stick with me because I'll come back to the US indices at the end of this video like I always do. First, let's cover international stock indices. There's Canada's TSX, which has been in a sideways range for over a year now. However, we can see the support zone right here where it's at the moment. And it's a little bit of a similar setup on some other international stock indices as well, like UK's FTSE. You can see the German DAX coming down to the support zone. China's 50 index coming back down to that low from October last year. Japan's Nikkei has been one of the better performing international markets this year, in a bit of a support zone. And the Aussie 200 right at the bottom of its support as well. There's a look at the weekly VIX chart, which is really low below 15 for much of the last 6 months. We can see that is definitely back on the climb higher, and actual volatility in the market as well. Got super low in the middle of the year, down to 8% annualized movement, but currently we're sitting at 13.7, which is still pretty low, and we haven't really seen the market uncoil yet. We haven't had many 2% down days all year at all, and so given the rip in yields and rise in geopolitical tensions, stock market is still pretty chill about this all. There's a look at bond market volatility, which is still pretty elevated, and the amount of stocks above their long-term average, now at 31%. You can see that's been in a bit of a strong downtrend, and we can see that actually peaked out back in April 21, at 96%. The stock market itself didn't peak out to late 21, the start of 22. You could see breadth was already declining for a few months going into that. And the highest we got was actually back in January this year at 76%. So there's the long-term breadth of most of the market. So most stocks are in bearish territory under their long-term averages. There's a look at the weekly chart of NYSE new highs. We can see in that bull market 2021, it's ripping up. Then again, that came off a lot earlier than the actual market did. Got a little bit of a bump up in the middle of the year. However, what we've been seeing over the last month or so is the amount of stocks hitting new lows significantly outweigh new highs. And we can see that on the NASDAQ as well. The amount of stocks hitting new lows, easily outnumbering the amount of stocks making new highs. So there's a lot of weak breadth out there. There's a look at the weekly chart of growth sectors versus defensive sectors. Been stalling out for the last few months. Growth versus value stocks. And there's a look at the strong downtrend of small caps versus large caps. The global growth spread of copper versus gold. See that sharp climb in 2020 going into 21. It topped out, and that's been on a downtrend ever since the start of last year as well. And look at that rip in gold versus treasuries on the weekly. What a move it has been away from treasuries into the shiny precious metal. Same with the 10-year, 2-year yield curve. Sharply uninverting back up to zero. And we've even got the 30-year, 2-year back above break even today, closing for the first time above break even since it went inverted over a year ago. Same with inflation expectations. Really sharp move up this week, as we can see in inflation protected treasuries. Short-term rates just kind of holding steady there. Market thinks the Fed is done, but they're making the government pay more for their bonds. We can see that in the move up in the 10-year and the 30-year, finishing the week at 508. And this has got some strong upward momentum and long-term yields. And again, no one knows for sure exactly when it's going to top out. Not even the escalating conflict in the Middle East was able to keep yields down for long, only just a few days. And that's what's caused TLT to have its worst drawdown ever, getting absolutely smashed down here. And like the old saying goes, it's hard to catch a falling knife. Treasury's getting hit even harder than high yield bonds, but they have been weak of late as well. Come down to big support we got from when markets bottomed out in October last year. Keeping the upside pressure on stocks is a strong dollar index, holding above this resistance zone around 106. And we've got Bitcoin, which has been jammed between this support and resistance for most of the year, moving back up to the top of that resistance. And there's a look at the commodity index as a whole. Strong dollar hasn't put too much of a dent in it. Was coming off in September going into October on the back of worries of global growth out of China. However, just looking at crude, that's bounced back the last couple of weeks on the conflict in the Middle East. And the big one has been the jump in gold. After we pinged off that support at 1830, now approaching all-time highs in this big resistance zone. And unless things really spill over in the Middle East, we're probably just going to consolidate around here in gold. We may get a little bit of a pullback along with crude. However, like we can see in the spread chart of gold versus treasuries, a lot has happened already. So things would have to truly get wild to see a big outbreak right away. However, this could set the wheels in motion for a medium long-term outbreak in gold as a really standout market and place to find refuge if things really escalate. There's a look at copper, which is in a bit of a downtrend as well. Over to stock sectors, there's meme stocks, been in a downtrend for a few months now, and semis stalled out at their highs from late 21. IPO stocks still weak, and we've got some pretty big breakdowns and some sectors this week, like consumer discretionary down 4.5%. Same with home builders down 4.5% on volume. Industrials finished lower. Airline jets had a bad week, down almost 5%, but back down at this support. Financials soft as well, down 3%. And the best sectors out there, energy and oil and gas, actually finished the week higher, 1%. And the winner being gold miners, up 1.8%. Another big loser this week was REITs, down 4.6% on the back of those higher yields. And no hiding out in the defensive sectors. Healthcare, staples, and utilities, all a bit soft. And there's a look at a new sector I've added to my list today, dividend stocks. Still on a bit of a bear market. They really compete with bonds for yield-seeking investors. There's a look at what I call the BlackRock barometer, a good indicator of the health of the stock market, being the largest asset manager in the world, custodian to a lot of the stock market. That to me doesn't look like a healthy, ripping, strong bull market. Even Warren Buffett's Berkshire Hathaway is pulling away from highs, and Apple still testing this support zone in the low 170s, along with Microsoft stalling out. The best performer, Google, still holding up a bit, Amazon peeling down, and this looks like a good old-fashioned head and shoulders pattern. In NVDA, we just need to see a close below the neckline around that low 400s. Call it 400 to close below 400. Could complete that pattern, and we may see the crowd psychology and sentiment turn on this one, which has pretty much been the biggest winner in the stock market this year and really propelled that AI story, which has helped to keep the main indices, S&P 500 and NASDAQ, doing well this year. The other key stock in the market is Tesla, the most traded stock, actually losing that support a bit here today, closing a little bit below it. And like most of these mega cap stocks, they're just going sideways at best. If not, we could be going into continuations of the downtrends that started early last year. Another one of the best performers with Google is Meta, but that could be putting in a bit of a double top here on a bearish divergence, and this too is losing momentum and stalling out. Another good performing stock this year was Oracle. Looks to have put in a double top and a bit smaller, but one of the best performing stocks this year, Supermicro Computer, again has stalled out on a huge bearish divergence. And some of the better performers in the meme space like Carvana, which went on an absolute tear from mid-year, that has topped out and come off a bit. And the old meme favorites of GameStop, of which I'm still short in my only bears portfolio, and AMC just been getting absolutely decimated the last couple of months. Same with the EV makers, they've been doing pretty weak, but the defense contractors are getting a bit of a bid in them. You can see they're waking up a bit on the likelihood of increased defense spending for a long time yet. And then look at the snack makers, Kraft Heinz, Pepsi, Mondelez, and Nestle all having a hard time of late. And there's the weekly charts of the old economy stocks that I like that have been beaten down really hard. And so like we can see, there's plenty of assets still very much in a bear market, and the regional banks were pretty weak today as well, so they're not completely in the clear yet. And even the big guys have been weak. Okay, so just going back to the S&P 500, we've closed below that trend line. Stocks are definitely on the edge here, and we could go into that free fall next week. Like I said, bad things happen in the market when it's already sliding down. The next big support we've got is around that 4100 level, where the market has turned a number of times before. But like we've seen in a lot of the charts, a lot of key stocks and sectors have put in these big topping formations, double tops, heads and shoulders, big bearish divergences. We've got the NASDAQ breaking down through the support. There's the S&P 500 equal weight right at a support zone. So we've got a lot of indices coming down to support. See whether they can hold and get a bounce next week. Option dealers didn't get what they want today, as we did have Max Payne a bit higher. There's mid caps and the Russell right down at its lows from last year. And it's the real small end of town micro caps finished at their lowest price in over a couple of years. So micro caps bear market is just deepening and getting worse here. The market's really been hanging its hat on the likes of Apple, Microsoft, Google, NVDA. However, like we can see, they're all stalling out and they could be the last shoes to drop, and they may actually catch up with the rest of the market. In which case, we would see the big indices, S&P and NASDAQ, take some big falls, because who knows when this US government bond 10-year yield is going to top out. This could be moving into a blow-off top pattern, and anything's possible. We could even reach 5.5% before we put in a top on this, and true capitulation in the bond market, because looking at the MOVE index and the VIX index, things are still not as bad as they could potentially get. So interesting times in the markets. That's all I've got for you this week. I hope you found some value in the video. If you did, I'd very much appreciate it if you hit that like button. I hope you all have a great weekend, and I'll see you again on Monday afternoon. Cheers.